Black-Scholes model. All right, you notice that everything that we just talked about, if I throw up the Black-Scholes pricing model, Fisher, Black, Myron, Scholes wrote this in 1973, the year the Chicago Board Option Exchange opened their doors and first started trading listed options. You see, all those variables that we talked about are in here, in this pricing model. And once you put those variables in, and one thing I want to also focus is you see a lot of square root of t's in here, right? You see those all over the place, and that's going to be fairly important when we start getting into the quick and dirty math of an option pricing matter. The square root of t is an important concept. So now we're going to spend the next 45 minutes deriving this formula and making sure they got it right. Just kidding. There's no reason to do that. And part of the reason why is that there's been a lot of models that have been done ever since the Chicago Board Option Exchange first started trading listed options. And the people that are down on the floor, the model matters a lot. They're trying to trade for nickels and dimes and pennies. And we're not. We're retail clients. We're trying to buy an option contract and get the direction right. We got the benefit of knowing that we're going to either buy a call or we're going to buy a put, and we know what strike price we're going to buy. On the trading floor, they don't. All they do is interact with your order. So we make that choice. They have to trade it. Now, they might have to buy, they might have to sell, and they might get a benefit of getting a little bit better price than us because they're buying on the bid and selling on the ask. But I've had this happen many times before when people come in and they say, I ran a Black-Scholes pricing model and the price of the option contract is way more than what the model says, than what my model says. So could you call the floor and have them update their quote? I have had that over the 30 plus years of teaching and executing options and working for brokers. I have had that question asked of me more than once. So that is a fairly important question to understand as we move on to the next state, because that just doesn't make sense. The price is what the price is. You see the quote, you see the quote. That's simple. All right. So bottom line is these are the pricing components of an option contract. You have the stock price, the strike price, the expiration date, interest rates and dividend, implied volatility, and premium. Put that into Black-Scholes model, Cox-Rubenstein model, whatever model you want to use, you will come up with a price for your option contract. Now, out of all of these variables, these are pretty straightforward, right? I can get a stock price. I can get a quote on Walmart if I want. Strike price, I determine. I select what strike price I want to interact with or buy or sell or whatever, however you want to call it. Expiration date, well, I can figure out the days to the expiration. Might have to take my shoes off, but I can count backwards and get to that expiration date. And then we have interest rates and dividends. The interest rate is going to be kind of the short-term money market rate, if you will, but that interest rate is fairly easy to find, and obviously we can get the dividend yield. Implied volatility. Now that's a little tricky if you're a retail client. Like, what is the correct implied volatility? And my answer to you is, I don't think we care. We know that we want to trade an options contract, and then if implied volatility is higher, it's going to cost us more to trade that. But we want to use this as a tool. So we want to know what that number is. Now, we can find the price of an option contract just by getting a quote, looking at an option sharing, and we can do that. But this is the biggest question. What is an implied volatility? And why is it called implied? All right, so to answer that question, first of all, let's define the terms. There are two types of volatility out there. We have historical, which is the annualized standard deviation of stock price movement. It's already happened. It's a fancy way of saying that we looked at the highs and the lows day in and day out, and we looked at how volatile the stock was over this period of time, and we came up with a historical volatility. It doesn't necessarily mean that the stock went up or the stock went down, but we can look at the past, look at the stock price movements, and we can decide, and we can come up with a number that we'll call historical volatility. Now, what's big is it's annualized, and that if it doesn't say 30-day or 60-day historical or 90-day historical, it's considered an annualized number, and that's fairly important if you want to, once again, understand the guts of an option pricing calculator, and that's what we're going to focus on today. Now, implied is the volatility that justifies a current options. Oh, let me try that again. It's the volatility that justifies an option's current market price and is also stated as an annual number. So once again, if it doesn't say 30-day implied, then it's assumed to be an annual number, and it can be found using an options pricing calculator.